Hello, Assalamualaikum to our lecturer Sir Sophie. In this slide, we will present about the financial ratio analysis for Southern Steel Bhd.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Kemal. Today, I will present to you about introduction and background of Southern Steel Bhd. A business needs a durable vision for effective planning and financial management. Ratio analysis is a useful management tool that can improve the understanding of financial results and trends over time, provide key indicators of organizational performance. This report investigates Southern Steel Bhd about the performance, progress, and achievement of the company. The ratio can endorse the company reply when it comes to various areas such as liquidity, profitability, efficiency, and solvency. Southern Steel Bhd is a big and strong company in their industry, so the analysis on their financial management for ratio must include all of these. The first one is calculated using reliable and accurate financial information such as official Southern Steel Bhd Annual Report 2019, used in comparison to internal benchmarks and goals such as industrial average in the same industries. Second one is carefully interpret in the proper context such as comment, justify and giving improvement based on the calculation. The third one is the ratios calculated are leverage ratios, profitability ratios and common size ratios. These ratios represented some of the standard ratios used in the business practice as provided in guidelines. As you can see, this is the Southern Steel Bhd logo. And now it's time for company background. Established in 1963, Southern Steel Group has developed from a little aroused iron sheet plant to a significant steel producing gathering. Southern Steel Group is a setup maker of a wide scope of excellent steel items, including billets, steel bars, carbon steel wire poles, steel pipes, ground wires, wire network, PC wire and PC strands. It is the greatest maker of wire items incorporating wire networks in the Southeast Asia. Its solid inventor lineup incorporates Hong Leong Manufacturing Group Sdn Bhd and Signaland Sdn Bhd, which are individuals from Hong Leong Group Malaysia and the group's establishing families situated in Penang. Hong Leong Group Malaysia is among the many 10 differentiated combinations in Malaysia.
The first ratio in liquidity ratio is current ratio. From this calculation, we can see that the company's current ratio is lower than the industry average. This means that 1 ringgit of liability will be backed up by 0.48 cent of asset. For manufacturing company, it is ideal for them to get a ratio of 2 because they have a large amount of current asset and current liability. However, in the heavy industry like the Southern Steel Bhd is operating in, it is normal for them to get a ratio lower than 2 because they possesses more non-current asset than current asset. Moving on to the acid test ratio. From the calculation, we can say that the company is less liquid than industry. The company is having a problem in paying its obligation on time without having to sell its inventory. The situation is very risky because the default payment will lead to an insolvency. Moving on to the debt ratio. From the calculation, we can see that the debt ratio of Southern Steel Bhd is bigger than industry's average. This means 47% of its assets are financed by debt and the remaining balance of its assets are financed by shareholders' equity. This situation is not favorable for a company because creditor will prefer a company with lower ratio because they want to minimize the risk of loss. Moving on to the debt to equity ratio. From the calculation, we can see that the company uses more equity than borrowing as source of their finance. However, Southern Steel Bhd uses more borrowing compared to the other competitors in the industry. For the time interest earned, it measures the ability of a company to pay interest charge out of its operating profit. From the calculation, we can conclude that Southern Steel Bhd is not able to pay its interest charge out of its operating profit because they did not generate any profit from the operation for the year 2019. There are three solutions for the company's problem. The first one is they will have to review the company's dividends policy. They also need to use retained earning or issuance of capital in financing companies' capital investment, and they will have to avoid taking additional debt financing. For the gross profit margin, we can see that the company is making RM 0.069 loss for every 1 ringgit of sales. We can say that the company less efficient in managing its cost of goods sold, and the company for the 2019 is not profitable. Having a low sales volume and high cost of goods sold is the possible cause why the gross profit margin is low. The suggestion is the company has to review its pricing policy. The company also has to change its supplier. The company needs to reduce its labor cost, and they also need to reduce the production wastage in order to improve their gross profit margin ratio. For operating profit margin, we can see that the company ratio is lower than the industry average. This is because they incurred high operating expenses and the profit become low. For the net profit margin, this ratio is not useful for companies that make losses because they do not have profit. In this case, a lower net profit margin is actually due to the company operating problem because it did not generate any profit from its operation for the year 2019. For the return on asset, it indicates the management ability to make a decision that will generate profit from the investment they have made. From the above calculation, the return on asset from Southern Steel Bhd is lower than the industry average. This indicates that the Southern Steel Bhd is not profitable for the year 2019. Southern Steel Bhd can improve its ROA by increasing its income as well as try to minimize the cost of asset. Hence, the ROA of the company will be higher in the future. For the return on equity, it measures the profit earned by common shareholder from their investment in the company. A higher ratio indicates that the company is doing well and it is satisfying its investor because it can generate more income for them in form of dividend. In this case, Southern Steel Bhd has a lower ratio than the industry average. This indicates that the company is having a problem in that period, therefore it cannot perform at its optimum level.
Next, we go to the common size ratio analysis. First, share capital has increased by 0.15% from 2018 to 2019, amounting Rm 711,000. This increasing amount is due to issuance of shares that have been made by the Southern Steel Bhd. Second, reserve has decreased by 16.65% in 2019, amounting Rm 63,244,000 due to the change of merged reserve, hedging reserve, and executive share scheme reserve. There is no change in redeemable convertible unsecured loan stock in the both years because there is no conversion of RCULS to share capital in 2019. Next, total equity in 2019 from 2018 is decreased by 6.31%, which is Rm 62,533,000. This considering as the decreasing in reserve and no change in RCU. There is no redeemable convertible unsecured loan stock in 2019 because the outstanding RCULS have been converted or redeemed. Deferred income has decreased by 16.39%, which is Rm 1,411,000 in 2019 because the amount have been amortized and recognized as other operating income in profit or loss of the company. Employee benefit for non-current liability are decreased by 3.10%, which is Rm 459,000 from 2018 to 2019, while for current liability it is increasing by 43.43%, which is Rm 119,000. Provision in 2019 was decreased by 50%, which is Rm 6 million ringgit because the provision for environmental costs had reversal during the year. Trade and other payable including derivative has increased by 0.7%, amounting Rm 1,594,000 and make the amount in 2019 Rm 229,013,000. This is because the increasing payable with the third party and related parties, and also the forward exchange contract designated as hedge instrument. The borrowing is increased by 1.16%, which is Rm 6,890,000 in 2019 because the increasing amount of banker acceptance amounting Rm 46,860,000. Total liability for the company decreased by 0.84% in 2019. It's because of the declining of non-current liability of RCULS, deferred income, employee benefit, and provision. Total equity and liability are decreased by 3.75% from 2018 to 2019. Both total equity and liability are decreased by 6.31% and 0.84% respectively. This shows this company has reduced the amount of debt and managed the equity well the amount in 2019.
In conclusion, the performance of the company can be recognized by using ratio analysis, which a useful management tool that can improve the understanding of the financial result and trends over the time. It also provided key indicators of organizing performance as the result carry out the figure that shows whether the company performance good or not, so they can upgrade their business performance accordingly. Overall report of Southern Steel Bhd, a Malaysia-based business company engaged in setup maker of a wide scope of excellent steel items, including billet, steel bars, steel wire poles, steel pipes, drawn wires, wire network, PC wires, and PC strands. It is the greatest maker of wire items incorporating wire networks in Southeast Asia. First of all, for liquidity ratio, Southern Steel Bhd current ratio is lower than industry average. Its liquidity portion is also lower than average. Having a ratio of 0.84 times means for every 1 ringgit of current liability, the company only has 48 cents of current asset as a backup. The industry average has 3 ringgit 66 cents. Asset test ratio indicates whether a firm has enough current asset to cover its current liability. Company with quick ratio less than 1 will not be able to pay its immediate obligations. In order to pay the obligations, the company has to sell its inventory. This is very risky because default payment will lead to insolvency. For leverage ratio, Southern Steel Bhd has high ratio of debt compared to other industries, as 47% of its assets are financed by debts and the remaining assets are financed by the shareholders' equity. Southern Steel Bhd uses more equity and fewer borrowings as the sources of financing as per calculation of debt to equity ratio. Southern Steel may be borrowing money more than necessary. This could be due to the firm's high dividend payout, leaving a less retained profit to be used for company expansion. Southern Steel Bhd should not take an additionally debt financing because of its high leverage ratio. Profitability ratio. Performance of this company is bad, which has ratio below than industrial average. This means that the company failed to control their cost of goods sold. It may due to expensive sources in supply of material, higher labor costs, and high production wastage. Southern Steel Bhd can solve this problem by review its pricing policy, reduce cost of sales by changing the suppliers, reduce labor costs, and reduce production wastage. Other than that, Southern Steel Bhd need to reduce the operating expenses as well as the cost of goods sold. The company also has to review its product pricing policy. Last but not least, for the common size ratio of Southern Steel Bhd shows that the company being well performed as the liabilities on long term was decreased from 2018 to 2019, unless for short term was increased for employee benefits and trade and other payable. Total equity of the company decreased from 2018 to 2019 as there is a lot of liabilities during the year. That's all from me. Thank you.